else would you do this job?
So let these guys talk for me.
Right. I gotta say, I'm incredibly excited to be a part of your firm. I mean, the clients you have are absolutely...
Fuck the clients. Your only responsibility is to put meat on the table.
That's all we're doing here, putting meat on the table.
I'm married.
We want
My wife, her name's Teresa. She cuts hair.
some good food.
Thank you.
Think about Teresa. Name of the game, move the money from your client's pocket.
Okay, cool. Welcome, everyone. How do we get back? Welcome, everyone, to Inside Traders. This is a show where we talk about the order flow for option trades in the stock market and scheme and scam and try to figure out how we can scalp and trade our way and swing around around the markets. My name is Caleb. I'm your host. And yeah, welcome to the show. So we're going to make it a pretty quick one today and talk about the order flow. And then I'm going to reverse everything I've ever said on this show and tell you the exact opposite because my opinions have changed. But yeah, let's start with the order flow, and then I'll tell you how my perspective has changed kind of over the weekend in this break that we had from markets. So, yeah, these guys, they were calling up Tesla so much today. It was tons of premium going into Tesla. Let's see. Oh, we're already on it. So, yeah, one of the things that I've started doing lately is looking especially close at the order flow into close. And we can see that like coming up around 10 minutes before close is when a ton of companies kind of like position themselves for the next day. And by companies, I mean individuals, investors. And what they are doing is they're trying to get ahead of like any like rapid buying or selling that we see into close. And so you can see that by the timestamps here, from about 30 minutes up to about the 50-minute mark, we get these like puts coming in at different time periods, basically telling Tesla to stay put at 250, which is a great number to stay put. And I should be participating, but I've gotten burned too many times, so now I can't have fun with you guys. And so all I can do is watch from afar and report what I see. And what I see is actually pretty bullish still on Tesla into close. What it looks like to me is there was some hedging. Let's get to the screen. Is this the right screen? Oh, nice. It's already there. So let's go back to Tesla. So it looks to me like there's hedging, and then we don't see a big sell-off into close, and then we see a couple of more, actually pretty big premium here, 879,000 buys coming into close. And what does all this mean? I don't know. It's kind of interesting. I've taken a step back and I've like evaluated my own behavior here. And 3 months ago, I would say I was a much more passive investor and participant in the markets. Let's use that title versus investor or trader. Let's just say I was a market participant who was spending much less time in it. And then I got obsessed with this idea that I could create a system that could figure out the price of stuff for me and then instantly execute it. And I went a little ham into trading. And so I've like kind of gone to the extreme of both worlds. And of course, the truth is always somewhere in the middle. Now kind of how I'm looking at things is day-to-day trading, even if you can make some big premiums, is something that has to come after a extremely stable and proven portfolio, because the risks really are too high. Like you can't tell, nobody knows what the stock market is going to do tomorrow. Nobody can tell you if the price is going to double or fall in half, even if we have like a lot of clear trends. So now I'm kind of taking a step back and being like, okay, what would actually be useful to people? Probably not like focusing on the riskiest bets in the market, although they're so crazy how much the volatility moves. It's something to deal with in the long term, and focusing more on why we should stay in the markets, basically why we should continue to be market participants and carve out as much equity as we possibly can. And I think that the trick to doing that is something I've never done. I've only ever lost, but I'm still here trying. And that is to make the most money while the market is going down. And so to do that, you have to think and act like a bear. But you don't want to be a bull in bear season, and you don't want to be a bear in bull season. So it's really important generally to just go with the flow. And if I think back to all of my kind of mistakes in my career, like being a market participant, most of them have come from just bad behavior, honestly, like bad behavior. Doubling down when I should have sold, like it's always actually that I'm like a double downer. That's my thing. But like more and more, I'm learning to sell and build tools to help me sell. And, that kind of brings me to this like ideal portfolio design, which I think anyone could do. And it's so true that anyone could do it that I've come to like be a little hesitant in even putting it out there, because, you know, in theory, if anyone could do it, then bad guys can do it too. And so it's not like I have some hidden secrets or anything, but I have found a couple of tricks of the trade in terms of just being paid to take on risk. And people can figure out what that means. And it's not like, the one thing that's for sure in markets, there's no silver bullets, there's no hacks, there's no tricks, there's no quick get rich quick anything. What there is risk and reward. And then on the risk side, it really comes down to how well can you manage risks and how well do you understand the risks. And all of that is hard enough in the world of stocks. And on this show, we're dealing in the world of options. So it's like as hard as it is in stocks times like, 12, freaking 6. There's like a matrix of probabilities indicators and parameters that set the price of an options contract, and they all like impact each other. So it's combinatorial, and meaning that there's lots of collisions and side effects in all of the inner workings of these properties of an options contract. So, but even to take a step back further, so in my reflection on like, I love looking at this tape stuff and like thinking about what these guys are doing. And in the longest of terms, when I get good at managing the risk, I do think there's an opportunity to like turn this into kind of a game. But for now, I want to take a step back, because even in my own behavior, like I was living, breathing, eating everything markets. And that's not like very healthy. I think it's fine to like have periods of time where you like dial in on stuff and focus on it. But the healthy approach with money is abundance. The healthy approach with money is I do have enough. Like that is the thing. Like here's what enough is. Like a homeless person has enough, they just decide to live on the streets. That's enough for them. Arguably, they're richer than the person who's got to buy another house, who's got to get in it. Like after you get a house and a car and a thing and a that, and you fill it with normal human stuff, even then, like you're just playing a game of how big of a house and how new is the stuff and that kind of thing. And so it's satisfying. I love buying things. It's like, I used to have a little thing for Amazon, in that, like, I don't know, like there's something great about getting a package, right? It's like a gift. You're getting a little present every day. You get to unwrap it. A package a day keeps the sadness away, I think was my slogan for Amazon. But obviously, shopping can be an addiction. Markets, gambling, all this obviously can be an addiction. Call it an addiction. That's like calling a stockbroker an addict or whatever. Like, people just love the numbers, and they love to be able to put what they know to work in those numbers. And so you can call that whatever you want. And if they're right, they get paid. If they're wrong, they get not paid. So yeah, like I think the thing I was excited about with starting this show was like, holy shit, we can see where all the premium goes. We can just like watch the order flow. That's crazy. That really influences my trade decisions. And then also just these charts, like getting a feel for these different levels. Like, we are at some interesting levels, not really on Coinbase. I think it could go anywhere still. The Coinbase range is like the Tesla range. It's like 150 to 300. Coinbase is maybe 60 to 90, I'd say. But who knows? I have no way to estimate. Nobody has any real knowledge. The landscape could change favorably or detrimentally, or, it could be bad, and then the price could be affected by that or not, and nobody knows. But what I do know is that we get these ranges and we get these patterns that you can see, and they're cool and fun, and I like looking at them. So I'm going to keep doing it, if only for that, in that way. So yeah, like, let's zoom out a little bit on coin. How far back are we into the retracement? Not quite at this upper level. We didn't test there. See, the sellers are going to want to test this line. Now, what do you do with that information? Are you going to put money behind it? I don't know. Like, it's a risk no matter what, because there could be a global, something unrelated to markets that can influence the price. So when you do these things, you just have to make sure that you can like have the time and attention and knowledge to actually manage the trade. And otherwise you're just like buying willy-nilly. You don't even know what you own. And so then when things go down, you don't know what to sell. And so it's important to be able to like manage the risk and not take on more risk than you can manage. And that is a big reason I want to build tools to support all of my market participation, including when I'm an active participant. But I think I do want to just mostly be an inactive participant. I think there will be times where I want to trade, and where I feel like this is a good time for it or whatever. But it is such a good way to put real capital at risk that can otherwise be locked so safely in this kind of a construction of a portfolio. So I've like blown up many portfolios in my life. I'm great at it. I'm so good at it. They're not implosions. They're always explosions. Well, first they explode, then they implode. So, it's like a star. But I've never, hit a black hole. We've always like had enough dust to rebuild or whatever. And in these experimentations, like I have found a few things about shares and options that are helpful. And so I don't think that it's worth sharing all of it, because I don't want to, like, it comes back to this idea that like we shouldn't be obsessed with markets. We shouldn't be obsessed with money. Like, what's the right attitude of money is to really have enough. And that means that your inflows are more than your outflows, and you don't even think about it. And when you go to the grocery store, you're not like worrying about a coupon. You're just buying the thing that your eyeballs want. And Yeah, anyway. So that's what I think is kind of the point of money, is to make it so you don't even think about it. And it would, the curse would be to have like $100 million or whatever, and then still be worried about money. That would be true poverty. True poverty. I don't know why I can't say that. Poverty. That would be true poverty, is to have all the money in the world and not be able to like be freed of it. And there are tons of people like that. And so I feel like I was promoting that attitude a little bit on this show of not abundance, not like money is a fun game tool for life. And so that is more what I want to focus on. And so what do I mean by that? Like that it's like that money, like people have to free themselves of money. You have to have some way to know that either by your own skills or assets in hand that generate cash, or just like gold bars buried in the freaking whatever, you got to know that you have some freedom from money. Otherwise, it dominates you. And so here's something, just throw it out there. If you were to just use like $1,000 with max margin in an account, you could just buy 100 shares of something, short that in the 2025 longest term possible as collateral. I mean, you can do this in other ways, but this is like a way that's generally available to everyone. Take that premium, dump it all into the same shares, and then use a small piece of it to buy a put. And now you kind of like built a little bit of a machine there. And let me explain how the machine works. And so if the price goes down, then your put plus your sold call is actually going to make you money. It's going to make you money. If the stock goes up, your sold call is going to cap your returns and eat away at your returns. And in the immediate term, especially depending on the moneyness of the put, your put will keep you put. And so you won't make much. So you'll kind of be pinned a little bit. And then what can happen is you're still getting value in the shares. It's just getting eaten away in the sold call and the put, which is like, I've been on the other side of that where I've had way too many sold calls and not enough upside. And so there's a balance to these things that we are going to figure out one way or the other. And when we do, it'll be awesome. And so just stay with me here. So we have $1,000. We buy 100 shares of something that has high implied volatility. Lucid, just buy Lucid for now. It changes all the time. There you go. And then like, don't do this. If you do this, you're an idiot, for real. But like, you just find something with high IV, and then in the 2025 range, you sell a call that's like 15% out of the money, because you're probably going to have to pay a premium for that sold call, because there's not going to be any buyers, because who would buy that call? But the market makers will sell it to you because they know it's a bad deal. But you just want the cash. And basically what you're trying to do is take advantage of the amplification effects of margin, and which is maybe the most powerful tool in finance ever created, margin. But it's so dangerous and hard to, like, you can control, like, I don't know. It's like lifting a mountain with a needle or something. It's like insane. It's crazy the kind of leverage you can get stacked on it. And so, but then like it creates this high risk situation. So you got to be able to manage that risk. And so to be able to manage something, you have to first understand it and have all the data and information about it. And so, yeah, what was I talking about with markets? Like, we don't want to be slaves to money. We don't want to be defined. We don't want to be having a bad attitude towards building wealth. It should be hands off for the most part. It should be as hands on as you want it to be. That's what it is. And so that's what I think is it should be as hands-on as you want it to be. So here's what's cool about what I was describing as a way to like sell these calls and take advantage of margin. If you do that, you can basically get into an amplification effect where the better you can balance it, the better the reaction. It's kind of like a nuclear reaction that way. You got to have a little bit of your anti-reaction material, and then you got to have more of your reaction material. And then you're trying to find the right energy balance. So also we can drive some stupid fucking steam engine is the stupidest part of nuclear ever. Like we do all this shit with boron and like radioactive bullshit. Why? Why do we do it all? To produce steam, to like turn a turbine. But it's like we've been doing turbines and steam from the whole time. We went from burning trees to turbines and steam, and we're still there. It's just we do it now with like nuclear power. It's very frustrating to me that we have no way to directly take advantage of the energy released in E equals mc squared. But I think that is the point of fusion, is it gets closer to that interaction where we're not just like, you know, driving another turbine. We're actually starting to tap into the Einstein's equation, equals mc squared. So anyway, back to you got $1,000, you want to amplify it and create monopoly money. Okay, how do you do it? So we're going to sell a call that's going to give us like 40% of the cash value of those shares in equity, which we're going to remove permanently forever from those shares. So they're dead shares now. And we're going to put that into inverse delta. Inverse delta. So what does that give you? Well, if you have a ton of inverse delta, that means you have a ton of headroom for positive delta. Now, where like you can implode is if you ever get rid of your inverse delta and you keep your positive delta, well, now you're totally off sides. And like, how are you even going to calculate your delta? You didn't even know what that means. So like, you're fucked. You can't even do this, but it's hard to do. But like, still, just in theory, it is possible. And the theory isn't even that complicated because every time you sell a call, you can just look at the Greeks and it's going to have a delta and it's going to be like negative 2.8, whatever. And in that delta, that creates all this room for positive delta. And so like you can do that by cramming in shares, or you can do that selectively with calls. And then now the question becomes, well, when do you buy and when do you sell? And I would argue if you're doing the system that I'm thinking, which I've never accomplished and have only ever, I'm still evolving these ideas. I'm just thinking out loud here. And so like, I'm sure I will have revisited this in the future and think some things different. But what I'm saying in terms of like how margin can amplify your returns, really your strategy, it can do that in a way that you benefit from a downside and an upside. So like if we get there, we'll get there live on the show. That'll be awesome. And we'll have talked about it before we actually did it, and that'll be cool. And so that's the idea anyway, just like you can harvest these premiums, and then what are you going to do with that premium? Well, I think that is the question. Like, what are you going to do with that premium? That depends on where you are in the charts. And so, for example, if you are at an all-time high of 115, that might be a good time to roll your calls, buy some puts, and be able to profit from the inevitable retracement that happens when you reach a new all-time high. Now, NVIDIA bears have been getting burned on this for like a year, right? So it's like, it's not that easy. Nothing is that easy. It doesn't work like that exactly. But just the point is, we were talking about like, what do you do with the premium that you get from the sold call? Okay, well, the whole point of it is to amplify your margin. Now, how are you going to amplify it best? That just depends on where you are technically. And if you're in a place where you think you're technically near the bottom, you should be buying out of the money calls. If you really do believe that, if you really believe that you are at a technical bottom and that come hell or high water, the price will keep going up, then that is what you should do. Now, that's a dumb thing to bet on because nobody could ever know that, right? And so be more conservative in your bets, obviously. But still, like if you are at all-time highs, then we're not even buying calls, we're buying puts. Now, I'm not saying willy-nilly here because like technically speaking, once you break into a new all-time high, there's no telling how high it can go. And so there's a good argument to like finding the ceiling with NVIDIA seems to be $500. We'll find out. And so anyway, that's kind of the idea is like, okay, so if you were going to take on max risk because you got $1,000 and who cares if I lose this, fine. I'm going to sell calls every single day. I'll use the premium I get that day to amplify my margin. How am I going to amplify it? That depends on the technicals. If I am, down here at $69 and I see this giant green volume bar rising, then yeah, that'd be a good time to buy a call. And then if I'm up at like maybe not even $88, but some level, like that might be a good time to buy puts, like 115, for example. Like you would probably get paid to buy a put at 115. Even if we only fall down to like 112, it's still, we always have to retrace just because the price always wants to test the lower boundary and then the upper boundary as well on the way up. And so at least so far as I've seen, but see how tight the Bollinger Bands have gotten right there? That means something's going to happen. And it's kind of like staying above this line. Where did that even come from? That might be made up. Made up line maybe. Anyway, what was I talking about? Yeah, and the cool thing about selling calls and then whatever you do with that premium you do, is it really is a lot more hands off, and it actually installs not a floor, but it's like an airship. Yeah. It's like so it's easy to be the Hindenburg is the point of that. An airship, like a helium hydrogen filled balloon that, if you remember the Hindenburg, it went up in flames, which is probably what's going to happen the first 5 times you try this. If you do try it. And then the trick becomes, how do you buy back? See, this is hard. Like people can't just do this. So I'm not that worried about putting the ideas out there because could people even do them? People who know what I'm talking about could do them. Like to those people, like why can't you just do this? Sell a call, take the premium, amplify your returns. What are you going to put the premium into? If let's just say you're right no matter what, right? Like if you're going down, you buy puts. If you're going up, you buy calls, whatever. Or you just buy shares and then sell more calls against those. Either way, you have a bearish, a bullish, and a neutral action that can be taken. And the goal then would be, how am I ever going to liberate myself from these sold calls so I have complete ownership? I would argue maybe you don't even want to do that totally because of the airship idea. Like they're giving you like this base to operate from above, and then that lets you like lift some weight from below. The reason is because it unlimitedly caps your upside. So what you could then do is, as you're going down, you could purchase full ownership of your shares, assuming you had timed your puts technically well. So like maybe you were the guy that knew to start selling or buying puts above 110, and you started stacking them all the way up from 110 to like 115, and then you knew not to sell them somehow. You just knew it until like $90. And so you held them that whole $10 range. So they like 10x or whatever. And then now you start selling those puts, and what do you do with the premium? You buy back your sold calls, and then you take some portion and you keep them in some long-term put. So like the put is a shelf for your stocks to sit on, and like they are just gonna like not go lower than that number. Now, if the stock price is like $100 and your put is like $70, then all that in between is premium that gets burned and wasted, and it doesn't become effective until it reaches the strike price. So like you need basically to buy an at the money put if you want effective insurance at the time you purchase it. But still, the price changes as the number goes down is, I think, what most of the people are interested in. Although the most interesting part of puts is after that strike price, it's all like a 1-to-1. It's all cash. It's like the delta is 1. So it's -1. And so pretty cool thing about puts. So yeah, puts are like a shelf for the stocks to sit on, and then calls are like this magnetic roof or airship that is like hoisting up the load or whatever. That's how I think of it. Sold calls versus purchase puts. Credit calls, debit puts. So yeah, that's the idea, is like you just stack up these calls, and then that gives you a ton of negative delta that lets you take on a lot of risk. Problem is, if you ever buy back those calls through the liquidation of shares, you might still like have a ton of positive delta, and then things are offsides. So that is why knowledge is key to all this, and we need telemetry. We need to know where we're going and what our vector is and what our environment is. And so we need to gather metrics and data to be able to calculate in real time, second by second, every 300 milliseconds, what is the delta of all of my contracts in this position in shares as virtual contracts, my portfolio as a whole, or even like baskets and things, and then pin that delta by purchasing negative equity or selling calls and gaining negative equity that way. So I have some ideas on all this stuff. I would like to be challenged on it, like verbally. Please don't just like attack me and be like, I challenge you. But no, like I'd like to ideate on this and think through it, because the thing that's crazy about margin is it kind of makes for an unlimited possibility. So because your margin gets amplified every single day, and that means if you're always using your maximum margin, then you're always going to amplify your strategy, which is really good if your strategy is the right one for that market, and really bad if it isn't, which is why it's so dangerous, because nobody really knows. But there are some things that we can do that are independent of any market in any season, which is basically just hedge, always hedge. And if you're feeling bad that you have all these sold calls, that's probably a good time to buy puts. Probably means you should be buying puts. And if you're like going down, if the market is going down, then you're going to love having those sold calls. Like that is going to be a great break. And you're not getting like to have to mess with margin calls or any of that stuff. And so, but like none of this stuff is so simple or easy. And I think the number one thing that matters is having access to all of the right information in as much real time as possible. But then the whole question comes back to like, why do any of this? Like, why even think about this? I don't know. I mean, it's pretty fun, like to like that it's possible to do these things. I think it's worth playing with for a season. I don't think I want to like be obsessively reading charts forever, but it's cool to do it for a season. And so, yeah, like maybe that'll be how I end this show, is if I ever get bored of reading charts, then we'll know. But I'm definitely not bored of it. And I just want to do more and better and share what we learn, and we can all like get to the same place, possibly around the same time. Wouldn't that be fun? And yeah, so just to go back to the flow, what were they doing? NVIDIA, I think they were pretty bullish on actually still. Let's see. Whoop, whoop. All right. Well, I don't have a helpmate for this. So I have a small spilled drink. So I guess that is God. That is a sign from above to end the show. But first we'll look at NVIDIA. Puts into close. There you go. All right. That's a good way to end it is on NVIDIA. Puts into close. That's the puts and takes. There's the idea. If somebody hears this, leave a comment. Tell me what you think. And have a good day.